Silver just hit $64 an ounce. Financial media is calling it a massive rally, a historic breakout. Some analysts are warning that silver is overheated, that you've missed the move, that it's too late to buy. But what if I told you that at $64, silver is still the cheapest major asset on planet Earth? Not cheap compared to what it was last year. Cheap compared to what it should be worth based on pure mathematics. The kind of mathematics that makes Wall Street very uncomfortable. By the end of this video, you're going to see silver completely differently. You're going to understand why $64 isn't expensive. It's actually a discount so large that future generations will look back and wonder how anyone could have missed it. And I'm going to prove it to you with nothing but simple math. No hype, no conspiracy theories, just numbers that anyone can verify. Before we dive in, if you're new here, this channel is about understanding money the way they should have taught you in school. Hit subscribe and turn on notifications because what we cover here could change your financial future. Let's get into the math. The first comparison I want to show you is the most important one. We need to go back to January 1980. In January 1980, silver hit $50 an ounce. That was 45 years ago. Now most people hear $50 in 1980 and $64 today and think silver has gone up. It's more expensive now than it was then, but that's not how money works. And this is where the math gets interesting. $50 in 1980 is not the same as $50 today. Inflation has destroyed the purchasing power of every dollar printed since then. To understand what $50 in 1980 actually means in today's money, you have to adjust for inflation. When you do that calculation, $50 in 1980 equals approximately $190 in 2025. Let me say that again. Silver already hit the equivalent of $190 45 years ago. Today's price, $64. That means silver is currently trading 66% below a price it already reached in 1980. 2/3 below its previous high, adjusted for inflation. Think about what else has happened since 1980. The stock market is up over 4,000%. Real estate prices have increased 3,000%. Gold went from $850 at its 1980 peak to over $2,600 today, tripling even after inflation adjustment. Every major asset class has blown past its 1980 highs. Every single one, except silver. Silver is the only major asset still trading massively below where it was 45 years ago. In a world where everything costs more, silver somehow costs less. If silver simply returned to its 1980 inflation-adjusted high, it would need to triple from here. Not because of some wild prediction, but just to match a price it already hit when Ronald Reagan was president. That's comparison number one. Now let's look at comparison number two, the gold to silver ratio. Right now, gold trades at approximately $2,650 per ounce. Silver trades at $64. If you divide gold by silver, you get a ratio of about 41-1. That means it takes 41 ounces of silver to buy 1 ounce of gold. Is that ratio normal? Let's look at history. For most of human civilization, the gold to silver ratio averaged between 12-1 and 15-1. The Romans set it at 12-1. The United States Coinage Act of 1792 set it at 15-1. For thousands of years, this ratio held relatively stable. Today, it's 41-1. Silver is cheaper relative to gold than it has been for most of recorded human history. Now here's where it gets interesting. When this ratio gets extremely stretched, it tends to snap back violently. In 1980, when silver hit $50, the ratio collapsed to 17-1. In 2011, when silver hit $49, the ratio fell to 32-1. If the ratio simply returned to its historical average of 15-1 and gold stayed at $2,650, silver would be worth $177 per ounce. If the ratio returned to the 1980 low of 17-1, silver would be worth $156. At $64, silver would need to nearly triple just to reach a historically normal relationship with gold. That's comparison number two. Now let's do comparison number three, silver versus other assets in 2025. The S&P 500 is at all-time highs. The index has returned over 4,000% since 1980. Price to earnings ratios are stretched above 25, which historically indicates expensive valuations. Real estate is at all-time highs. The median American home costs $420,000. Home prices have never been higher relative to median incomes. Bitcoin is at all-time highs. It crossed $100,000 in 2024, up from essentially zero 15 years ago. Gold is at all-time highs. $2,650 per ounce, breaking records that stood for years. Every single major asset class is at or near all-time highs. Now look at silver, $64, 66% below its inflation-adjusted 1980 high. 41-to-1 ratio against gold when historical average is 15-to-1. Silver isn't just cheap, it's the cheapest major asset on Earth by almost any mathematical measure. But here's what makes this even more remarkable. Let's talk about what's happening with silver demand. Silver isn't just a precious metal, it's the most electrically conductive element on the periodic table. It's the most thermally conductive metal. It's the most reflective metal. These aren't opinions, these are physics. These properties make silver absolutely essential for modern technology. And demand is exploding. Let's start with solar panels. Every solar panel requires silver for its electrical contacts. There is no substitute that works as efficiently. As the world races toward renewable energy, solar installations are growing 30% per year globally. In 2020, solar consumed about 100 million ounces of silver. In 2024, that number exceeded 200 million ounces. By 2030, conservative estimates suggest solar will consume over 300 million ounces annually. To put that in perspective, the entire world only mines about 820 million ounces of silver per year. Solar alone could consume nearly 40% of global mine supply within 5 years. Now add electric vehicles. The average electric vehicle uses about 1 ounce of silver. That doesn't sound like much until you realize the world is projected to produce 70 million EVs per year by 2030. That's 70 million additional ounces of demand that barely existed a decade ago. Now add electronics. Every smartphone contains silver. Every computer, every tablet, every server, and every data center. As artificial intelligence explodes and data centers multiply, silver demand from electronics keeps climbing. Now add medicine. Silver has natural antibacterial properties. It's used in wound dressings, surgical equipment, and medical devices. This demand grows steadily every year. Now add traditional investment demand. When economic uncertainty rises, people buy physical silver. Coin and bar demand has surged since 2020. Add all of this up, and you get a simple picture. Demand for silver is at record highs and growing rapidly. Now let's look at supply. Global silver mine production has been essentially flat for a decade, around 820 million ounces per year, give or take. Mining companies aren't building new silver mines because, until recently, the price was too low to justify the investment. It takes 7 to 10 years to bring a new mine online. Even if companies started today, meaningful new supply wouldn't arrive until the 2030s. Meanwhile, above-ground stockpiles are shrinking. We're now in the 4th consecutive year of structural supply deficit. More silver is being consumed than is being produced. Let me repeat that. 4 years in a row, the world has consumed more silver than it has mined. The gap is being filled by drawing down existing inventories. And those inventories are getting thin. COMEX registered silver inventory has dropped 65% since 2021. The London Bullion Market Association has seen similar drawdowns. The vaults are emptying. Where's all this silver going? A lot of it is going east. India imported over 300 million ounces of silver in 2024, the highest in recorded history. China doesn't report accurate numbers, but satellite imagery and shipping data suggest they're accumulating massive amounts as well. This is physical silver leaving Western vaults and heading to Asia. It's not coming back. So let's summarize the math so far. Silver at $64 is 66% below its 1980 inflation-adjusted high of $190. The gold to silver ratio at 41-to-1 is nearly 3 times higher than the historical average of 15-to-1. Every other major asset class is at all-time highs, while silver remains 2/3 below its previous peak. Demand is at record highs and growing exponentially from solar, EVs, electronics, medicine, and investment. Supply is flat and has been for a decade. We're in the 4th consecutive year of supply deficit. Inventories are draining and heading east. By every mathematical measure, silver is absurdly cheap. So the obvious question is why? Why is silver so undervalued when the math is so clear? Why hasn't the market corrected this obvious mispricing? That's where this story gets really interesting. And it involves a 44-year-old system designed to keep silver cheap. In part 2, I'm going to show you exactly how the silver price has been suppressed, who benefits from keeping it low, why that suppression is finally breaking, and what happens when 4 decades of artificial price control meets unstoppable physical demand. The math says silver can't stay at $64. Something has to give, and I'll show you exactly what that looks like when it does. In part 1, I showed you the math that proves silver at $64 is the cheapest major asset on Earth, 66% below its 1980 inflation adjusted high. A gold to silver ratio nearly triple the historical average. Record demand from solar panels, electric vehicles, and electronics. 4 consecutive years of supply deficits. Inventories draining and heading east. The math is clear. Silver should be much higher. So why isn't it? The answer involves a system that's been in place for over 4 decades. A system designed to suppress the price of silver, and that system is finally breaking. Let me tell you a story that most people have never heard. In 1979, 2 billionaire brothers from Texas named Nelson and William Hunt looked at the world and saw the same things we've discussed in this video. Money printing, inflation, dollar devaluation. They decided to protect their wealth by buying silver. They didn't just buy a little silver, they bought a lot. They accumulated an estimated 100 million ounces, roughly a third of the world's total supply at the time. As they bought, the price rose. Silver went from $6 an ounce in 1979 to $50 an ounce by January 1980, an 800% increase in about a year. The financial establishment panicked. If 2 brothers from Texas could corner the silver market, what did that say about the stability of the paper money system? What would happen if everyone tried to exchange their paper dollars for real silver? So they changed the rules. The COMEX exchange, where silver futures trade, implemented something called liquidation-only trading. This meant you could sell silver contracts, but you could not buy them. Only sell. Think about what that means. They made it illegal to buy. You could only sell. What happens to any market when buying is banned but selling is allowed? The price collapses. Silver crashed from $50 to under $11 within 2 months. The Hunt brothers faced margin calls they couldn't meet. They eventually declared bankruptcy. And a message was sent to anyone who might try to challenge the paper money system again. But here's what's important. The mechanism used to crush the Hunt brothers didn't disappear. It evolved into something much more sophisticated. Today, the silver market operates on a 2-tiered system. There's the physical market where real silver changes hands, and there's the paper market where contracts representing silver are traded. The paper market is much, much larger than the physical market. On the COMEX exchange, the ratio of paper-silver contracts to actual physical silver in the vaults is approximately 300 to 1. For every 1 ounce of real silver that exists, 300 ounces of paper silver are traded. This isn't illegal. It's called fractional reserve trading. The same concept banks use when they lend out more money than they actually have in deposits. The paper market sets the price. When banks want to push the price down, they sell massive amounts of paper contracts. These aren't sales of physical silver. They're sales of promises to deliver silver that may or may not exist. This constant selling pressure from paper contracts keeps the price artificially low. Is this manipulation? In 2020, JP Morgan paid $920 million to settle charges that they manipulated precious metals markets for over 8 years. They admitted to placing hundreds of thousands of fake orders to manipulate prices. This isn't speculation. It's documented fact. They paid nearly $1 billion in fines, so the silver price has been suppressed for over 40 years through paper market manipulation. The Hunt brothers discovered this in 1980. JP Morgan paid nearly $1 billion for doing it in 2020. But here's what's changing. The paper game only works as long as people accept paper promises instead of demanding real metal. The moment physical demand overwhelms the paper supply, the entire system breaks. And that's exactly what's starting to happen. Remember those inventory numbers I mentioned? COMEX registered silver inventory down 65% since 2021. London vaults draining steadily. This is physical silver leaving the system. Where is it going? India, China. Individual investors who learned from 2020 that when systems break, you want to own real assets, not paper promises. The paper to physical ratio is being tested like never before. Let me explain what happens when a fractional reserve system faces a run. Imagine a bank that has $1 million in deposits but has lent out $10 million. As long as everyone trusts the system, this works fine. Only a few people withdraw at any time. But if everyone shows up at once demanding their money, the bank fails. There isn't enough real money to cover the paper promises. The silver market works the same way. 300 ounces of paper silver for every 1 ounce of physical. As long as everyone accepts paper settlement, this works. But India isn't accepting paper. They want physical delivery. They're taking real silver and shipping it home. China is doing the same. So are millions of individual investors worldwide who've lost faith in paper promises. When paper and physical diverge, the price doesn't rise gradually. It reprices violently. We've seen this before. In 2020, physical silver premiums exploded while the paper price stayed flat. People were paying $30 for silver coins while the paper price showed $20. The physical market was screaming that the paper price was wrong. That gap has normalized somewhat, but the underlying pressure hasn't gone away. It's building. So let me give you the 3 scenarios for silver based on pure mathematics. Scenario 1 is the conservative case. Silver simply returns to its 1980 inflation-adjusted high of $190. This requires no change in the monetary system, no short squeeze, no crisis. Just silver catching up to where it was 45 years ago in real terms, from $64. That's a triple. Scenario 2 is the ratio reversion case. The gold to silver ratio returns to its historical average of 15 to 1. With gold at $2,650, this puts silver at $177. Again, roughly a triple from current levels. Scenario 3 is what happens if physical demand actually breaks the paper market. If the 300 to 1 ratio collapses because there isn't enough physical silver to meet delivery demands. In past cases of commodity short squeezes, prices have gone up 10 to 20 times. I'm not predicting this, but mathematically, silver in a genuine short squeeze could see prices that seem impossible today. The point isn't to predict exactly where silver goes. The point is that by every mathematical measure, $64 is not expensive. It's a price that requires the current suppression system to continue working perfectly forever. And 44 years of history suggests these systems don't last forever. They work until they don't. And when they break fast. So where does this leave you? If you watched my last video about why your salary buys 50% less than your parents did, you learned that the money itself is broken. Since 1971, the dollar has lost over 90% of its purchasing power. Every year you hold cash, you get poorer. The wealthy have protected themselves by owning assets, real estate, stocks, gold, things that go up when dollars go down. But most of those assets are now expensive by historical standards. Real estate at all-time highs, stocks at all-time highs, gold at all-time highs. Silver is the exception. At $64, silver is still 66% below its inflation-adjusted 1980 high. It's still trading at a historically extreme ratio to gold. It's still accessible to regular people. You don't need $50,000 for a down payment like real estate. You don't need $2,650 for an ounce like gold. You can buy a single ounce of silver for the cost of dinner for 2. This isn't financial advice. I'm not telling you what to do with your money. I'm showing you mathematics. The math says silver is mispriced. The math says the suppression system is under unprecedented pressure. The math says physical demand is overwhelming available supply. What you do with that information is up to you. But let me leave you with one final thought. 45 years ago, silver hit $50 when there were no solar panels, no electric vehicles, no smartphones, no data centers, no AI revolution. Silver hit $50 when demand was a fraction of what it is today. Today, silver is the most critical industrial metal for the technologies defining our future. Demand is at record highs. Supply can't keep up. Inventories are draining. And the price is still 30% below that 1980 level, even without adjusting for inflation. At $64, you're not buying at the top of a bubble. You're buying an asset that's been artificially suppressed for 4 decades, while demand has exploded around it. The math says this can't continue forever. The only question is whether you understand the math before or after the rest of the world figures it out. If this video helped you see silver differently, share it with someone who needs to understand what's happening to our monetary system. Subscribe if you want to keep learning how money really works. And ask yourself this question. If silver at $64 is still 66% below its inflation-adjusted high from 1980, still trading at 3 times the historical ratio to gold, still facing record demand against flat supply, still being drained from Western vaults and shipped east, then what is silver actually worth? The market will answer that question eventually. The math already has. I'll see you in the next one.